Good morning and welcome to Financial Accounting. Today is, as you can see on the screen, November 8th, and this is the fall 2022 semester. We are working on chapter 11 today. So looking at what we have due, chapter 10's the comprehensive problem. You know that's worth a little bit more than a regular chapter problem. So during the semester, we have two after chapter 4, and now after chapter 10, that is worth a little bit more than, it's worth, I think, 5% of your grade for the comprehensive problems. That's 2.5% of your final grade for the one that's due today. So you should expect that to take a little bit more time, a little bit more effort than the typical chapter problem that we've had after most chapters this semester. We are going to be covering chapter 11 this week on corporate bonds. And so the chapter 11 pre-quiz should be submitted for grading by the end of the day today. As always, you need a 60% or higher to get full credit for that. And then on Thursday, we'll be finishing up chapter 11. And so the chapter 11 exercises would be submitted and the problem is due next week. You can see there on the screen, there's also an extra credit problem that is optional for this class. So if you would like to do the extra credit problem, that also should be submitted next week. Questions, anybody about any of that? So nothing out of our ordinary format here. So last week, we covered chapter 10 on mostly on current liabilities. We did talk about some non-current liabilities. Any questions, anything you wanted to talk about from chapter 10? If you haven't looked ahead far enough in our syllabus, you may not have noticed that our next test, and I know you just took a test this past weekend. Everyone just took a test this past weekend, but we've already covered chapter 10, which was not on that test. This week, we're going to be covering chapter 11. And our next test, exam 4, is the one that only covers 2 chapters. So we talked about this earlier in the semester. There are 5 exams and 14 chapters. So exam 1, 2, 3, and 5 all have 3 chapters, but exam 4 is the one that has only 2 chapters. And those 2 chapters are the 2 that make sense to go together. The 2 chapters on liabilities. So it's the chapter we did last week and the chapter we're going to cover this week. So I'm not sure that this schedule goes far enough to show, but our 4th exam covering just these 2 chapters from last week and this week will actually be at the end of next week. It's the weekend before Thanksgiving. I'm sure you're all very aware and eagerly anticipating that the week of Thanksgiving is vacation. There are no classes that entire week. But before you leave on vacation, you will need to complete exam number 4. As you can see, with as far as I can get on this schedule, the problem for chapter 11 is due next Tuesday, 1 week from today. That's the last piece of our work for exam 4. And so you can take exam 4 anytime after you finish the chapter 11 work. I would really encourage you to consider taking it maybe even before you leave campus to go home for the break, so that once you go home, at least as far as this class is concerned, you can be turned off from accounting and actually enjoy your time at home or wherever you're going to be for Thanksgiving. And I do have a review session scheduled for that exam. All of the review sessions are from the last exam, this exam, and the next exam, finally, last exam, are at 9:30 on a Monday or a Wednesday. And so the review session for this upcoming exam will be next Wednesday at 9:30. Again, I hope you're able to join us, but please do not skip someone else's class to attend that review session. If we have the review session, if anyone is signed up, and we have the review session, I will record it and post the recording, just like I have for all the other review sessions this semester. So, and hopefully, because this is just 2 chapters, unlike the one we had last week, we'll be able to get through the entire practice set in that review session. You should be able to sign up in Starfish. I don't know what happened last week that it was blocking some people out, but you should be able to sign up in Starfish. So please go ahead and try to do that if you are able to join us next Wednesday. So questions, concerns, anything you want to talk about before we start chapter 11? For you guys who are on Zoom, we do have a large number of people on Zoom this morning. If you do have any questions, you are welcome to unmute and ask your question, but if it's more convenient for you to use the chat to type out your question, you're welcome to do that as well. This. And we will get started with our chapter 11. As I said, this chapter is strictly on bonds payable. So we talked about, and you should have read about in your textbook for chapter 10, that it really covered, at least mentioned, lots of different types of liabilities. We focused mainly on current liabilities in class, although we did mention the idea of pension obligations. I also very briefly mentioned the other post-employment benefits that companies may need to include on their balance sheet as liabilities. You can read about those if you haven't already in your textbook for chapter 10. And so what that leaves for this chapter is the idea of bonds payable or corporate bonds. So as you know, we're discussing this whole semester, we're focused on the corporate form of organization. GAAP, generally accepted accounting principles, are the required principles for any publicly traded company in the United States. And so that's what we're learning this semester. And as I mentioned last week, corporate bonds take kind of a special place in our accounting life, to the point that it gets its own separate chapter in the book, because it is the main way that companies have access to financial capital to borrow. So one of the advantages of the corporate form of organization is they can, if they need money, if they need cash to invest in their company, they can go directly to the public to raise that capital, where other types of business organization do not have access to the capital markets in that same way. So what we're talking about in this chapter is one of the primary ways that companies can access the financial markets, and that is by issuing bonds. Essentially, they're borrowing money, but rather than going to a bank to borrow a very large amount of money from just one source, they go to the public and try to raise money, maybe $1,000 at a time from a bunch of different investors. And so in this chapter, we're focused on that borrowing piece of the financial markets. And in our next chapter, which we'll cover next week, but is not on the exam at the end of next week, that will carry over and be included on exam 5 at the end of the semester. Next week, our focus will be on stockholders' equity, which is the other way that corporations have access to the financial capital markets. And that is by selling stock, by bringing in new investors. So between this week and next week, we're going to be covering the foundation of the capital structure of a corporation. Where do they get the money, the financing to do whatever it is they're trying to do? To invest in their business, to expand and grow and do whatever else they're trying to do. So two primary ways they do that: by borrowing through the issuance of bonds, and by selling stock, by bringing in new owners, new investors. I wanted to point out also on this slide, I always show you the learning outcomes or the objectives for the chapter. And this is the one and only time this semester that we're actually going to be doing one of the learning objectives from an appendix. So we're going to be covering for this chapter objectives 1 through 5. Okay, so number 5 on the screen is from appendix 1, but we are actually going to be talking about that. It uses the present value concepts, which are a very important part of accounting. And so we will be covering that learning objective from appendix 1. We are not talking about appendix 2. I will mention it. I'll kind of explain what the difference is, but you're not responsible for being able to do that part of accounting. I just want you to know it exists and why, how it's different, and maybe why we don't do it in this class. I also wanted to show you, I'm going to go in Brightspace to the reference materials folder for this chapter. And you'll notice in the reference materials folder for chapter 11, there are a couple pages of useful information, formulas that are going to help you with this chapter. And so I'll be referencing these as we work our way through the exercises. We have formulas here for amortizing bond discounts and premiums using the straight line method. And the other one we'll use for that appendix, which is valuing bonds and finding bond prices. So I know those are quite dense text, a lot of words on the screen, but I needed to give you the formulas or the way of doing that so that you can follow it through, especially when I'm not right there. So I will be referring to these as we move through the chapter using those formulas. And I wanted you to be aware that they are there so that you can access them on your own. And second, because I covered up my Zoom tools here. Okay. Everybody good so far? So you should have your chapter 11 exercises open and see now. Once again, I put the exercise that should have been last, I put it first and neglected to move it. And by the time I realized that, someone had already opened the assignment, which means I can't make that kind of a change. So when we get to our exercises in just a moment here, we will be starting with exercise 2 from chapter 11. And next class on Thursday, we will finish up with exercise 1. So I already mentioned a bond is a way of borrowing. I showed you last class, actually, or maybe 2 classes ago. It was McDonald's annual report that I had up on the screen, and I showed you how to find that table at the end. And God bless you. In the notes to their financial statements, the table that showed the outstanding long-term liabilities, and it showed the dollar amount, the interest rate, the due date for each one of those. In the notes to the financial statements that referred to that as their notes, but that's what we're talking about, that concept of those long-term liabilities. The textbook spends a few pages talking about these characteristics, the nature of bonds payable. I'm going to kind of go through this pretty quickly, not because it's not important information, but because I don't have a lot to add to what's in the textbook. So I don't need to waste anyone's time sitting here in the classroom talking about terminology, but it is something you should be certainly reading in the textbook on your own. And if you are stuck on something, if you have questions, obviously you are encouraged, you should be asking those questions in class. So I really look at this chapter similar to the way we looked at chapter 9 on the long-term assets, that we're going to walk through the entire life cycle of a bond. So how does a company decide they're going to sell bonds? What goes into that decision-making process? How do we record it when we sell them? How do we record it as we go through the life of the bond? And then what happens when the bonds are done at the end of their life? So you should be familiar with every step in that process, the types of accounting, the types of entries, journal entries that need to be made as we go through that whole life cycle. So as you already know, bonds are a type of borrowing. We are the borrower, and we borrow generally from the investing public. That could be individual investors, it could be institutional investors, it could be other businesses that are buying up bonds in this company. We borrow because we need that financial capital, we need the cash for usually some specific purpose. The board of directors of the company would need to approve the issuance of a bond. So when we decide to issue a bond, we have to make a determination, a decision about a number of different pieces of information. So how much is it we're going to borrow? We talked about, when I gave you that simple interest formula, I used the term principal or face value. We have to decide the face value of these bonds that we're issuing as well. So maybe we're going to issue $1 million worth of bonds. And so we have to decide that face value. We have to decide the interest rate we're going to pay. So just like if we borrowed from a bank or some other lending institution, we're going to have to pay interest. But unlike when we borrow from a bank, and it would be the same if you were going to borrow from a bank, you go into the bank and you say, okay, what are the interest rates today? The bank or the lending institution dictates what the interest rate would be, right? If you want to buy a car, you go for a car loan, they tell you, here's the interest rate. Well, for bonds, it's kind of the reverse of that. If we're going to issue bonds, we decide what interest rate we're going to pay. That's called the stated interest rate, or the coupon rate is another term for it, or the face interest rate. We say, here's how much we're going to pay, and the investing public says, okay, I'm happy with that rate, or I'm not. We have to decide, the board of directors has to approve, and then once we've done all of that internal, yes, we're going to issue these bonds, here's the face value, here's the interest rate we're going to pay, here's how long those bonds are going to last. So we call that the maturity length, or the duration of the bonds, which could be 5 years, 10 years, 30 years, 50 years. There are even some 100-year bonds out there. And we have to decide all of those pieces of information. And then we go to the SEC, Securities and Exchange Commission. We go to the SEC to get approval to issue these bonds. And then once we have all that approval, only then can we actually issue the bonds or start selling them. And usually we're going to do that through some kind of an investment bank. We're in business to make widgets. We're not in business to sell bonds. So we need to hire somebody to do that for us. And so that would be an investment bank that handles the advertising and sale of these bonds. If you know anything about interest rates, if you've ever tried to get a loan for buying a house, buying a car, buying whatever. If you know anything about interest rates, you would know that they change, they fluctuate even on a daily basis. And so, as I just described that whole process of getting the internal approval, then the external approval from the SEC, and then actually selling the bonds. Remember, we decided what interest rate we were going to pay. And now it might be, I don't know, a few months later, and we sell the bonds, and the interest rates in the market might almost certainly have changed since we decided the interest rate we were going to pay. And so if we're paying a higher rate of interest than what the market, if interest rates are falling, which is not the case right now, if you don't follow this, I will just throw out there the Fed, the Federal Reserve, has raised interest rates 3 times in the past couple months. And they've been pretty significant hikes, up to 0.75% at a time. And so interest rates are not falling right now, they're rising. But in the case where we set our interest rate 3 months ago, if interest rates are rising and other bonds are now paying a higher rate of interest, are people going to want to buy our bonds? Are people going to want to lend us money if the interest rate we're paying is lower than what they can get for lending their money to someone else? If you are lending money, do you want a higher rate of interest or a lower rate of interest, all else equal? Higher, right? You make more money if people are paying you more interest. And so if our bonds have a lower rate of interest than other bonds, people are going to say, I don't want those bonds. And so what do we have to do to get people to buy them from us? We have to lower the price, right? How do you get someone to buy something that they otherwise wouldn't buy at the existing price? You put it on sale. Kind of do the same thing with bonds. So as interest rates are rising and we're not paying a competitive rate of interest, our bond prices are going to fall. There is, I'll put this on the screen. I know it's in the PowerPoint at some point, but I want to have you see it now. So there is an inverse relationship between bond prices and interest rates. There's an inverse relationship between bond prices and interest rates. In other words, if interest rates are going up, bond prices are going down. If interest rates are going down, bond prices are going up. That's what we mean by an inverse relationship. They're going in opposite directions. If we set the interest rate we are going to pay and it turns out it's too low, it doesn't mean we can't sell our bonds. It just means we're going to have to lower the price. And we would say that those bonds are selling at a discount. But the opposite is also true. If interest rates are falling, and so the interest rate we are paying ends up being a higher rate of interest, that makes our bonds look more attractive. People want our bonds because we're paying a higher rate of interest. And so what would happen? The price on our bonds would go up. We would say those bonds are selling at a premium. And so those two words are going to be very important for us throughout this chapter. The idea of the relationship between the interest rate we are paying and the market rate of interest dictates whether our bonds are selling at a premium, which means they're selling for more than face value, or at a discount. They're selling at less than face value. So I've already talked about the interest rate that we are paying, which is the stated interest rate, or the, I referred to it as a coupon rate, or the effect, there's another term on here, the contract rate, the stated or face interest rate. All of those terms really mean the same thing, which is what we said we would pay. The other important term is the market rate of interest, which is what the market is demanding right now for bonds that are of a similar risk as ours. So we've talked about in an earlier chapter that when someone is more risky, they have to pay a higher rate of interest. Well, the same thing is true for corporate bonds. If our company is seen as a high risk, we're going to have to pay a higher rate of interest because investors want to be compensated for taking that risk. This visual explains the relationship between the interest rate we are paying and the interest rate that the market is demanding, and how that affects the price at which the bonds can be sold. And so I would encourage you to refer to this. I also have this relationship in one of those pages in Brightspace for you, but I don't have the nice picture. I just have the relationship explained. So why would they sell at a discount? Why would they sell at a premium? And the middle situation, which is much less common, probably statistically rare, where the rate of interest we are paying is exactly the same as the market rate of interest. We would say they're selling at face or at par. So if you're a golfer, you know what it means to golf par. You golf, your score is exactly what it's expected to be. It's the expected value. Same thing is true for bonds. If they're selling for exactly their face value, you would say that they're selling at par. But as I said, that doesn't happen very often. Statistically rare. Skip through those. Okay. So we're going to go to our next exercise, and we may not use the PowerPoint again until we get to that final exercise related to how do we analyze or how do we use this information to make a decision about a company. Because I just think it's much more valuable to actually work through the exercises as we talk about the concepts. What I've just gone through very briefly is the information from Learning Objective 1 in your book, which is talking about bonds, but not really doing the accounting. So I would strongly recommend that you pay particular attention to that learning outcome number 1 in the book, because there's definitely information in there that we did not just cover. As always, if you have questions on something you read, because I'm telling you, you're responsible for the information that's in the book, even if I didn't just talk about it. So if you read something and you're not sure what it means or how to use it, you should ask. But let's go to our first exercise for today. Bigger. No, that's okay. So as I said, I want to go through the entire life cycle of the bond. So the first exercise we're going to do, exercise 2 and 3, actually deal with issuing bonds. So what does that look like? So I already talked through the approval process that would be required. Internally, it's got to be approved by our board of directors. And then we go to the SEC for permission, and then we sell the bonds. The exercises make it, for almost all the exercises except one that we're going to do, the exercises make this really simple for us as far as the accounting. We're going to make some assumptions, or we're going to be given some information that simplifies things, but we'll talk about what does it look like in a more realistic scenario. So when we get permission to sell these bonds, we have to, as I already said, decide what's the face value of the bonds, or the principal that we're trying to borrow. What's the interest rate we are going to pay? When are we going to pay interest? So the vast majority of corporate bonds pay interest semi-annually. That means that they pay twice a year. And you can see in this exercise, it tells us that we pay interest. We're planning to pay interest on May 1st and November 1st. And so those are 6-month interest payments. We make them twice a year, every year, for the time that the bonds are outstanding. That's different than the notes that we've talked about up to this point. We talked about notes that pay all the interest, calculated as simple interest. We pay all the interest when the note matures, which might be three months or 3 years from now. But all the interest is paid at the end with the face value. We talked about amortized loans where each time you make a payment, you pay the interest and reduce the principal, just like if you have a car loan or a mortgage on a home. That's an amortized loan where you're making an interest and a principal payment. Bonds are different than all of those options. With bonds, the typical, and the ones that we're going to be looking at, you pay the interest only every 6 months for the life of the bond. And then when the bond matures, you make that final interest payment the last 6 months, and you pay off the face value of the bonds. Okay. So with what we're given in this exercise, it says Thomson Company produces and distributes semiconductors for use by computer manufacturers. Thomson issued $1.2 million. So that's the face value. That's the principal. That's the amount they want to borrow for whatever purpose. Of 10-year. So that 10-year represents the maturity length or the duration of these bonds. They're 10-year bonds. That makes them long-term liabilities, right? Because they're not due for 10 years. In 10 years, then, we have to repay our bondholders a total of $1.2 million. We have to pay that face value back to our bondholders. Now, we decided we were going to pay 8% interest. How did we decide that? Well, we looked around at what's going on in the market, and we looked at bonds of similar risk. So those don't have to be companies that are doing the same thing we're doing, but companies that have a similar risk profile. So bonds are rated by a couple of different agencies, such as Standard & Poor's and Moody's. They rate bonds, and that bond rating tells investors how risky that bond is. So a higher rated bond, a AAA bond, is going to have a lower interest rate than a bond that has a very poor rating. It might even be low enough that we would call it a junk bond. So those are going to be very risky bonds, and they're going to pay a higher rate of interest. So we looked at the rating for our company and said, okay, 8% with what's happening in the market and our risk level, we think 8% is the right interest rate. Again, it's different than if you're borrowing from a bank and the bank tells you, here's the interest rate. We're the borrower, but we're kind of guessing at what the right, I mean, it's an educated guess, don't get me wrong, but we're speculating on here's what we think is the right interest rate for our bonds. And then we throw it out there and we see what happens. It's a little more formal than what I'm describing. We're going to issue these bonds on May 1st. So this is one of those simplifying factors that I mentioned, because you'll notice May 1st happens to be one of the interest payment dates. And so if we sell these bonds on May 1st, that means the first interest payment is going to happen on November 1st, and it's going to be for the full 6 months. People who bought the bonds on May 1st, by November 1st, have earned a full 6 months worth of interest. We'll see in an exercise on Thursday. Sorry, I just remembered about daylight savings time, and it occurred to me I wasn't sure if the clock on the wall had the right time on it. It does, so we're good. So we will see one exercise where we talk about, well, what happens in the much more realistic scenario that we didn't sell all the bonds exactly on the first day of the new interest period, because that's much more likely to happen. In reality, it's not likely we sell every single bond all on the same day. You know, we sell out the first day they're for sale. But for most of our exercises, we will be told that that is the case, and it just makes it easier. So May 1st, we issue the bonds for cash at their face amount. Again, not a very likely scenario. For this exercise, we're using the information that's given. We sell them at their face amount. But what do you think the chances are that a couple months ago, when we started talking about selling these bonds and we got approval from our board and then from the SEC, and then we, sold them, what are the chances we guessed exactly correctly about what the interest rate ought to be? A few months ago, as I said, since a few months ago, we've had 3 separate interest rate hikes by the Federal Reserve. And so that has changed the prevailing interest rates in the market because of the actions of the Federal Reserve Board. So the chances of us guessing exactly correctly, pretty slim. But again, it makes our entries here easier. And so we'll go with it. If we sell them at face value, what's one account that's going to be affected on May 1st? What do we have now that we didn't have before? We have a bunch of cash, right? How much cash do we have? Yep, 1,200,000. We sold them at their face value. It's generally not going to be the case. And in the next exercise, we'll see, well, how do we know how much cash we got then if we didn't sell them for their face value? So now we have a bunch of cash, so we can do whatever it is we wanted to do to invest in our company. But what else do we have? What's the other account that's going to be affected? Bonds payable, I heard. So yeah, we have that cash on the asset side of our balance sheet, but guess what? We have to pay it back in 10 years. And so we have to show that long-term liability, bonds payable. That bonds payable account, by the way, must always show the face value of the bonds. Even if that's not what we got when we sold them, that's how much we have to repay at the end of the length of the bonds when they mature. In this case, 10 years from now. Everybody okay with that entry? So what happens next? 6 months later, November 1st, our bondholders, which could be just one entity that bought all $1.2 million of the bonds, the typical individual bond is worth $1,000 face value. Or they can be in increments of 1,000. So there might be $5,000 or $10,000 bonds. But generally what we are talking about are, or what we use as an example in class, are $1,000 bonds. So this would be, could be 1,200 individual $1,000 bonds. It could be that we have 1,200 individual investors, each of whom contributed $1,000, lent $1,000 to our company. We don't know that. We don't need to know that for this exercise. But of course, if we're the company, we would need to know who owns the bonds so that we know where to send the interest payments, right? A couple of terms that I didn't cover in Learning Objective 1, but they are definitely in your book. What I just described is what's called a registered bond, where the company has a record of who owns the bond so that they know where to send the interest check. It's a registered bond. Another, the other option is, rather than being a registered bond, it can be what's called a coupon bond. A coupon bond is not registered with the company. I know this shows my age, but is there anyone in here who has seen the movie Beverly Hills Cop, the first one? With Eddie Murphy, Beverly Hills Cop, anybody? But you don't remember one little scene that I'm going to talk about here in a second. So 20 years ago, I'm just saying, when I started teaching accounting, people in the classroom knew what I was talking about. I highly recommend that movie if you can get around the unfortunate language. If you know Eddie Murphy, you know that that's going to happen in his movies, but he's a funny guy and it's a good movie. But so the premise of that movie is Eddie Murphy's character, Axel Foley, is he's a cop in New York, and he has a buddy. And his buddy comes to see him at his apartment in New York. He's coming to see Eddie Murphy's character, and his name is Mikey. And Mikey's like at the door of Eddie Murphy's apartment, he's in the hallway, and he gets executed, shot like at the back of the head, execution style kind of hit. And the reason he gets killed is because he has stolen something from Victor Maitland, his boss in Beverly Hills. And Eddie Murphy goes to Beverly Hills to, track down his friend's murderer, basically. So that's the term Beverly Hills Cop. That's where the name comes from. If you've never seen the movie, all of that's probably new to you. But the question I would have asked if you saw the movie was, what did he steal? So it's kind of a trivia question. And what he stole, what Mikey stole from Victor Maitland is, in the movie, they call them German, because they're from Germany, German bearer bonds. Okay. Bearer bonds. A bearer bond is a coupon bond. What that means is whoever has the bond can literally tear off the coupon and redeem it for the interest. It's the opposite of a registered bond. You can't steal a registered bond. The company knows who owns it, and that's who gets the interest. You can steal a coupon bond because whoever has the coupon can redeem it for the interest payment. Does that make sense? So I still encourage you to see the movie. It's a good movie. It's funny. I'm not endorsing the use of the language in that movie, but it's funny. And now that you've been made aware that that Mikey gets killed over some German bearer bonds that he stole, you'll know what to watch out for. And just let me know if you watch it and you hear them say that. But it has definitely gotten to the point, 20 years later, that just like here, nobody in class has seen the movie, so nobody knows what I'm talking about. So the company issues these bonds, and we're now 6 months later, and we're going to pay the interest on those bonds. If these are registered bonds, which is much more likely the case today than that they would be coupon bonds. Historically, coupon bonds were probably more common. If you think about it, we talked about this earlier in the semester. Why would they have been more common? Because we didn't have the computer capacity. We didn't have the same technology available then as we do now for companies to be able to track this kind of thing. And so registered bonds are much more common today than coupon bonds, which used to be the prevalent form. So it's 6 months later and we have to pay the interest. And if it's a registered bond, we know who gets the interest. And if it's not, we just wait for people to bring their coupon into the bank, to redeem it and get their interest. We have already covered in the receivables chapter the calculation for simple interest. And we're going to be using that same formula here. I equals PRT. I have the formulas in Brightspace for you as well. But that's what we're going to be using. So for this exercise, because we sold them at face value, these calculations are simpler. In the next exercise, I'm going to show you how it gets complicated when we don't sell the bonds at face value. That the calculations get a little bit more complex. So what's the principal? What's the face value of these bonds? $1.2 million. What's the interest rate we said we would pay? 8%. And the time, this is 6 months, so it's just a half. The time is 1/2 year. And so that's the interest that has accrued on these bonds that we have to pay for the half year. Anyone get a number for that? $48,000. Thank you. So at the end of the first 6 months, we owe our bondholders $48,000. As I said, that could be 1,200 separate bondholders, each who own one $1,000 bond. It could be one entity that bought up all $1.2 million of the bonds. For our purposes for this exercise, we don't need to know that, but of course, the company needs to know that. Who gets the $48,000? So when we pay the interest, what do we use to pay it? Cash. So we're going to credit cash to show that we mailed out $48,000 worth of checks. And what is that $48,000? It's interest expense. So that interest expense is going to hit our income statement. It's going to reduce our profitability for this 6-month period. You'll notice from the entry we did on May 1st, that was what I would term a balance sheet transaction. Borrowing the money doesn't affect our income statement. We now have some more cash, but we also have a liability to pay it back. It's the using of that cash that generates the interest expense that then affects our income statement. Okay, so everybody good with that entry? Simple interest calculation. The interest that we paid in cash is the same as the interest expense we reported. And it's the same because we sold these bonds for their face value. Again, we'll see in the next exercise how that's different if we don't sell them at face value, which is much more likely. The last thing we have to do here then is on December 31st, our year ends. So we're using the calendar year as our fiscal year. And at the end of December, remember, we haven't made an interest payment since November 1st. So all of November and all of December has passed. We now owe the bondholders 2 months worth of interest. So we could redo this calculation that we did here for the interest payment and just calculate 2/12 or 1/6, 2 months worth of interest. I'm going to do it a little bit easier than that. And I'm going to say that I know that this interest is 6 months worth. So I just want 1/3 of that for 2 months worth. Make sense? So it's $8,000 a month. If 48,000 is for 6 months, it's 8,000 a month, which would mean $16,000 worth of interest is now owed at the end of December. I absolutely could have gone back to the original formula that I have up at the top, and rather than using 6 months, just use 2 months, 2/12 or 1/6 as the T part of the formula. So what does this 16,000 represent? Well, it represents the interest expense for November and December. The matching principle says, hey, you owe that interest, you need to report it. It needs to be on your financial statements for the end of the year. This is an adjusting entry. Because when are we going to pay the next interest payment? May 1st. But at the end of December, because we're closing our books for the year, we need to make sure we have all of the right information in there. And so we need to report that we incurred that cost, the interest expense for the 2 months on our income statement, and on the balance sheet, we need to show we owe the $16,000 in interest. So we call that a payable. Excuse me. So the bonds payable is going to show up on our balance sheet as a long-term liability because we don't have to pay back this 1.2 million for 10 years, 9.5 now. The interest payable, though, we're going to actually pay that amount on May 1st. And so that's going to be a current liability for us, the interest payable. Everybody okay with this exercise? Excuse me. I put check marks in there. And so that's the beginning of the life cycle of the bonds. We just issued them back in May. We made the first interest payment. If these are 10-year bonds, how many interest payments are we going to make in total? How often do we make the interest payments? So if we, every 6 months, yep. So how many times a year? Yeah, so we do it twice a year for 10 years, so we make a total of 20 interest payments. So let me just show you, before we go on to the next exercise, if we make 20 payments of $48,000, what's 48,000 times 20? That's a total of $960,000 in interest we're going to pay. Ouch. We're borrowing $1.2 million and we're paying back the full $1.2 million plus almost $1 million in interest over the 10 years. Kind of scary. 48,000 didn't seem like that much, but when you look at how many times we're actually paying it, it adds up. When we get to that appendix 1 that I talked about in the learning objectives, we're going to see, yeah, but that's $1 million spread out over 10 years. It's not really the same as $1 million today. And so we'll be looking at how do we take those future cash flows, $48,000 at a time, 20 times over the next 10 years, and figure out how much they're worth in today's dollars. So that's what we're going to be doing with that present value calculations that we do in appendix 1. Next class. Let's move on then to our second exercise for today. And this is going to be a more realistic scenario where we don't sell the bonds at their face value. That the interest rate we decided to pay is not exactly the same as the market rate of interest. Because since we had to make that decision that our board approved and then the SEC approved, interest rates have changed, which is again much more realistic. So on the first day of its fiscal year, Chin Company issued $15 million of 5-year 6% bonds to finance its operations of producing and selling home improvement products. Interest is paid semi-annually. So interesting quirk in the English language. This is where it gives us that word semi-annually. Bizarrely, in English, and I think we have maybe a few people in this class who are not native English speakers, so I apologize for the quirks of our language. In English, the word semi-annual and biannual can mean the same thing. So semi means half and bi means 2. Semi-annual to me is very clear. We're paying it every half year, semi, half, annual, year. So when you say interest is paid semi-annually, it means half a year, every half year. The word biannual is really, I try to never ever use this word in my speech because it's a ridiculous word. I'm just going to say it. Because in English, biannual, so bi means 2, just like a bicycle or bifocals. Biannual can mean it's paid, well, biannual can mean twice a year or every 2 years. And there's no way you can possibly know that by just seeing the word in context. That word is ridiculous. I would encourage you to never use it because it is so ambiguous to the person. You know, you're talking to somebody, say, oh, we have the biannual conference. Does that mean it's twice a year or every other year? No way of knowing. It's a stupid word. Just throwing that out there. Don't use that word because it's very unclear what you actually mean. I appreciate that they say that this interest is paid semi-annually, because semi-annual has one meaning. It means every half year or twice a year. The bonds were issued at a market or effective interest rate of 7%. So what did we say we would pay? We said we would pay 6%. But since we made that decision, market rates have changed, and the market rate of interest right now is 7%. So if we're paying 6%, but other bonds of similar risk are paying 7%, do people want to buy our bonds? Do our bonds look attractive to an investor? Hey, we're paying 6%, but I can get 7% over here from this other company. Why would I want your 6% bond? Isn't that what you'd be thinking? Why would I accept 6% when someone else will pay me 7%? Everyone sees that that's a kind of an issue, right? If you're an investor, you want the highest rate of interest you can get while maintaining a level amount of risk. So that doesn't mean that Chin Company can't sell their bonds. It just means the price will go down. No one's going to buy our bonds at full price because the interest rate we're paying isn't high enough. So what happens? The bonds get discounted. The value, the price of those bonds falls. So the face value is 15 million, but when we sell them, we only get $14,376,255. Okay, everybody see that? So this is going to make the accounting for this just a little bit more complicated than what we did in the last exercise. When we sell these bonds, what do we have that we didn't have before? What did we get when we sold the bonds? What did they give us? What did the bond purchasers give us? When you sell something, what is your customer, how do they pay you? Cash. So we have a bunch of cash that we didn't have before, just like in the last exercise. But in this case, how much cash do we have? It tells us we received cash of $14,376,255. So the cash part is based on how much we actually received. I should throw in there at this point. So I talked about, we probably almost certainly hired an investment firm to handle this, God bless you, to handle the selling of these bonds for us. Why did they do that? Out of the goodness of their hearts? No, they did it because we paid them a commission probably. And so the cash we realized here would be after they take their cut. They would give us, the sale price minus whatever commission they took. But remember when our board approved these bonds and then we sent it to the SEC and the SEC said, sure, go ahead, sell those bonds. We told the SEC that we were selling $15 million in bonds at face value. When we sell this $15 million in bonds, that means we are telling the people who buy them that we will repay them $15 million when the bonds mature in 5 years. So it doesn't matter that we sold them at a discount. Doesn't matter that we cut the price. We cut the price because they wanted 7%. We said, well, we're paying 6%, but how about if we give you some money off the top? And so, and I'm going to have to move that down the line. Again, the book or the software has led me astray by giving me that option. So I'm going to remove that. I apologize. Don't take that out for now because we need the debits before the credits, as you know, for a standard journal entry. So the cash we debit has to be the cash we actually receive, but the bonds payable, as I told you in the last exercise, must be stated at the amount we actually have to repay, the full face value of those bonds. So it's very clear in our template that something's missing because we've got this blank line right in the middle, the way I have it now. How else do we know that this can't be a final journal entry? What's wrong with it? It's not balanced, right? So the debits and credits aren't the same. How far out of balance are they? 15. Oh, thank you. 623, 745. Is that what you said? Perfect. Thank you. We need another debit of $623,745 so that our debits and credits are equal. What is that $623,000? It's the, go ahead. It's the discount. It's the amount we had to lower the price or put our bonds on sale. It is the discount that we had to take off the top to get people to buy our bonds because the interest rate we were paying wasn't enough. So what if we lower the price? Okay, if you lower it this much, we'll buy it. Everybody okay with that? So again, it's a little bit more complicated than the last exercise because the cash we received isn't the same as the face value. We will see this eventually. Trying to see what's our next exercise. Give me a moment. Yep, so we'll see this in our next exercise. That if we sell the bonds at a premium, if our interest rate is more attractive than the market interest rate, that the premium would be a credit balance. Discount, the discount on bonds will always have a debit balance. But if we sell them at a premium, we're going to see that as a credit balance. Okay. So now we have kind of two numbers that we're working with here. We have the face value of the bonds, but then we have the amount that we actually received from them. We have two different interest rates we're dealing with here because we have the face interest rate, the 6%, remember, is what we promised we would pay. But the 7% is what our buyers, the people who lent money to us, the people who bought our bonds said, yeah, but we really want 7%. And so those figures are going to come into play as we calculate how do we record the interest. And again, I'm going to remind you that the formulas that I'm about to use are in bright spaces, so you can see them there. But I'm just going to explain to you how to use them. So luckily, once again, we managed to sell these bonds at on the first day of the interest period. And so when we go ahead to number 2, when we make that first payment, it's for the full 6 months. And so in number 2, we're asked to record the first 6-month interest payment. So just like we did in the last exercise, the interest we pay will always be based on what we said we would pay, what we told the SEC we would pay, what we told our bond purchasers, the people who now hold our bonds, this is what we told them we would pay. The interest is the face value of the bonds times the face or stated interest rate. And it's a half-year payment. So the T part is 1/2. So I should label this the interest paid. So how much cash did we actually, how much cash did we actually send out to our bondholders? Anyone have an amount for that? Anyone have an amount for that? $450,000 is the interest we have to pay to the bondholders. And so how are we going to pay them? We're going to use cash. We have to pay them $450,000. but the effective interest rate on these bonds is 7%. Let me just show you the formulas. Ignore that blue writing on the screen if you would, please. And I'm going to go to the formulas because I think it'll be easier for you if I show you the formulas now, and so that you can see how we're using them. So what I just did was this part, the bond interest expense. Okay. Sorry, the bond interest payment. I highlighted the right thing. I said the wrong thing. The bond interest payment, the actual cash we spent, is based on what we told the SEC we would do, what we told our bondholders we would do. But the bond interest expense does not match. It's not the same amount as it was in the last exercise. It's not the same amount when there's a discount or premium. We are using the straight line method to amortize the discount or premium. We've seen that word amortization one other time in class. We talked about it in chapter 9 when we talked about intangible assets. We amortize some of those intangible assets as well. We have this bond premium or bond discount when we do not sell them at face value. And over the life of the bond, we need to gradually chip away at that premium or discount until it's down to 0. The main part of this chapter asks us to use the straight line method. In appendix 2, they have you use the effective interest rate method. We are not covering the effective interest rate method in class. However, it is a better way of doing it. It's just more complicated. So we are not doing it because it's in the appendix. In reality, though, GAAP requires that you use the effective interest rate method unless it's not materially different to use the straight line method. So if the straight line method is close enough, we're okay to use it. We are using it because it's easier. And because they've moved the effective interest method to the appendix, so we're not covering it, but it is the one that's more acceptable. And the reason, without getting too technical, the reason it's more acceptable is it results in a constant effective interest rate. And the straight line method does not. But it's close enough for what we're doing in class. So these are the formulas that we're using. I just want you to be aware that this is not necessarily the way it would be done, in the real world, but it is easier. And so with the way we're going to do that, the formula that I have highlighted here to point out to you, we take that original bond premium or bond discount as appropriate, and we divide it by the number of total interest payments. So what's our original discount? $623,745. How many interest payments are we making on these 5-year bonds that pay interest semi-annually? 10. And so the amortization would be $62,370. It tells us to round to the nearest dollar. So 374.5 would round up to 375. Okay. Everybody okay with that? Based on the formula that I just showed you in Brightspace, we take that full amount of the original discount and we divide it equally, just like we did for straight line depreciation. We take that and we divide it equally for each one of the interest payments. So the discount, I already pointed out to you, has a debit balance. And so to amortize that, to get rid of it, to chip away at it over time, we need to be crediting that account. So each time we make an interest payment, we're going to report, an amortization of the discount, $62,375. We're just chipping away at that discount. And by the time we make the 10th interest payment, the discount will be down to 0. We'll have to fudge a little bit on that last one because of the rounding we're doing here. Everybody okay with that? So that's the same number we're going to use every single time because we're using straight line amortization. So we already know that the debits and credits have to be equal. So how much is the debit going to be here? We just have to add those two together to find out how much the debit will be. 512,375. And that is the interest expense that we record. The rationale for recording more expense than we actually paid out as interest. The rationale for that difference is, yeah, but remember the market interest rate was 7%. So we need to be reporting interest expense that's 7% rather than the 6% we're actually paying. And so essentially what we one way of looking at this is we said we would repay you 15 million, but you only gave us about 14.4. So the other 600,000 that you didn't give us was kind of like us making up for that interest. It was kind of like you paid us that interest in advance and we're paying it back or something like that. So the interest that we pay, the cash that we spend is based on what we said we would pay, 6%. But on our income statement, we're actually reporting interest expense that's higher than that, that's closer to that 7% market rate of interest. Because really, we only borrowed about $14.4 million, right? But we're paying interest as if we borrowed the full 15 million. Questions at this point? So what makes, I said that the effective interest method, which is universally acceptable, is a little bit more complicated than what we're doing here with straight line. What makes straight line easier is once we have that entry, we just record the same thing 9 more times. This was a 5-year bond. We're paying 10 interest payments. Every time we make an interest payment, we report the same thing. If we use the effective interest rate method, it changes a little bit each time. This is easier because it's the same. Every interest payment looks exactly the same. Everybody good? Determine the amount of the bond interest expense for the first year. So in the first year, we sold these on the first day of the fiscal year. So in the first year, we've made 2 interest payments. We recorded the same amount in interest expense each of those 2 times. So what's the total interest expense that we recorded? $1,024,750. We reported as interest expense on our income statement. On the cash flow statement, this is not part of the exercise, but I want you to think about it. On the cash flow statement, what do we see as entries on the cash flow statement related to these bonds? Well, we see a $14.4 million cash inflow when we borrowed the money, right? But we would also see, if we use the direct method, we would see 2 cash flows, 450,000 each, a total of 900,000 that we actually paid out for interest. Our income statement shows the $1 million in expense, our cash flow statement would only reflect the 900,000 that we paid out. And again, the difference between those is we said we'd pay 6%, and that's what we're paying, but we're recording 7% basically. Questions so far? So the market rate of interest is blank, the contract rate of interest. Is it higher or lower? Market rate of interest was 7%, we're paying 6%, so the market rate is higher, greater than. Therefore, investors were not willing to pay the full face amount of the bonds. So the company was only able to sell them for about 14.4 because the interest rate we're paying wasn't high enough, wasn't competitive. We had to discount them or lower the price about $600,000 to get people to buy them. Okay, any questions from that exercise? Or anything we've talked about so far? Okay, let's go to our next exercise. Yes, yep, sorry. Yep, scroll down. Yep, so that's the simple interest calculation. Remember, it's over here in Brightspace. So the bond interest payment, the actual cash, is based on the face value, which in this case was the 15 million, times the face interest rate, which was the 6%, times 1/2, because it's a payment for just 6 months, not a full year. Make sense? It will always be a half, yes, as long as, because I don't think we're going to look at any exercises where it's not a semi-annual payment. That's the way it is almost always done for corporate bonds. So, yeah. Okay, so let's move on to the next exercise and we'll see what these similar entries look like when we sell the bonds at a premium rather than at a discount. So again, we're going to start with issuing the bonds. This exercise says at the top, Smiley Corporation wholesales repair products to equipment manufacturers. On April 1st, Smiley issued $20 million, that's the face value, of 5-year, that's the duration or the maturity length, 9%, that's the coupon or the stated or the face interest rate or the contract rate, all those terms mean the same thing, at a market or effective interest rate of 8%. So we said we'll pay 9%. In the meantime, interest rates have dropped. And so the market right now is saying, well, 8% is about the right interest rate for bonds of a similar risk. We can't go back and not pay 9% because that's what we got approved to pay. So we told the SEC we were going to do. So now our bonds look pretty darn good, right? Because we're paying 9%, other bonds are only paying 8%. People want our bonds. The price is going to go up. Interest rates have fallen since we set our 9% interest rate. Bond prices have that inverse relationship. If interest rates are falling, bond prices are going up. We're going to sell our bonds at a premium because people want our bonds more than they want other bonds that are paying a lower rate of interest. So how much did we sell them for? $20,811,010. That is the cash we received when we sold these bonds. But how much do we have to repay to those investors in 5 years when these bonds mature? How much do we have to repay? Just the 20 million, right? Just the face value. The extra $811,010 is the premium. And as I pointed out to you in the last exercise, the premium will have a normal credit balance, will always have a credit balance. The discount had a debit balance. But the premium is the excess that our bond purchasers paid us because our bonds are pretty attractive. We're paying a higher rate of interest than the market demands, and so the price of our bonds goes up. Everybody okay so far? So now, once again, they've made this easy for us by telling us that the bonds were all sold on the first day of the interest payment period. And so when we get to October 1st, the full 6 months has passed since these bonds were sold, and we're going to pay the full 6-month interest. So again, using the formulas that are in Brightspace, the interest that we pay is I equals PRT, the face value times the face or stated interest rate, and it's a half-year payment. So the cash we're going to spend is $20 million at 9% interest times 1/2, 6 months. And so the interest that we have to pay out, the credit to cash, is $900,000. But we know that the interest expense is going to be based on the amount that we actually borrowed, the $20,811,10. And the difference between the interest expense that we report and the cash that we actually spend is the amortization piece, the amortization of that premium or discount. So again, using the formulas from Brightspace, the amortization will be the full premium, the full premium that we reported initially, divided by the number of interest payments. So this is a 5-year bond paying semi-annual interest. How many interest payments will there be? 10. Twice a year for 5 years, a total of 10 interest payments. And so since we're using straight line amortization, that means we're going to record $81,111 in amortization each time. If the premium has a credit balance, to amortize that or to bring it down, we would have to debit that account, right? And now the interest expense that we report is the amount we need to make this entry balance. The interest that we pay, $900,000, minus the amortization of $81,101. And so what we're seeing here is exactly the opposite of what we saw in the last exercise. The interest expense that we report is less than the cash that we actually paid out, the $900,000. Why? Well, because we have to pay the 9% that we said we'd pay, but we only are incurring cost or expense based on the effective rate of 8%. So the interest expense we report on our income statement is less than the amount that we actually pay. On the income statement, we're going to see this interest expense. On the cash flow statement, if we use the direct method, we would see $900,000 paid out for interest. But we don't report all of that on our income statement. Why was the company able to issue the bonds for more than the face amount? Because the market rate of interest was less than the contract rate. The contract rate was 9%. We said we'd pay 9%, but the market rate of interest was only 8% at the time that we actually got around to selling them. So in this exercise, unlike the last one, we only journalized one interest payment. Why did we not have to do interest payment number 2, 3, 4, 5, 6, 7, 8, 9, 10? Because they're all exactly the same. The straight line method for amortizing this premium or discount means that every interest payment, the entry for every interest payment looks exactly the same, which is what we did here in letter B. So we could have repeated this for whatever, the April 1st of 2022, and then the October 1st for 2022, and so on, out for 5 years, but it would look exactly the same. So we saw that in the previous exercise. I'm just reiterating that now. Go ahead and get the green check marks in there. Any questions? So at this point, you should be able to record the issuance of bonds at a premium or discount, like we just did in the last 2 exercises. Oh, and recording them at face value, which is not very likely to happen, but you should know how to do that. We also know how to use the formulas that are in Brightspace to record the interest payments using the straight line method under the scenario that they were sold at a premium or at a discount. The first exercise we did, you'll notice, we go back to that now that you've seen what it looks like to record discount and premium. The first exercise doesn't include that discount or premium because they sold at face value. There is no discount or premium to be amortized. The interest expense that we report is exactly the same as the interest payable that we report. But as we just saw in the next 2 exercises, when they're sold at a discount or premium, there's going to be a discrepancy, a difference between the interest expense on the income statement and the interest we actually pay. And the difference is that amortization piece. Okay. Questions? Anybody at this point? So we could just go blithely along our merry way for the entire time that the bonds are outstanding and make our interest payment every 6 months on, like clockwork. That's what we said we would do. And then at the end of the duration of the bonds, when they mature, we could just pay back the full face value. When we make that final interest payment, we would also repay the full face value. As I said, you would repay that full face value even if we sold them at a discount or at a premium. The amount you have to repay when the bonds mature is that face value, regardless of whether you sold them at a premium, a discount, or face value. It's the face value that has to be repaid. But there might be some situations where a company wants to bring in their bonds and retire them early. And there's a number of different reasons that a company might want to do that. Some really common and legitimate reasons include, well, interest rates have changed. And maybe we sold those bonds when interest rates were high, and now that interest rates are lower, we could save money on our interest payments if we pay off those bonds and reissue new bonds at the lower prevailing interest rate. That's one reason. Another reason might be we've got some extra cash and we don't have any profitable uses for it in our business. Maybe our current project, maybe the reason we borrowed the money is turning a profit, generating a lot of cash faster than we thought. And so let's just pay off some of the bonds and save that interest payment altogether. It's the same concept as if you have, say, a car loan and you have some extra money, so you want to, make an extra payment on your car or pay an extra amount toward your credit card so that you don't have to keep paying interest on it. So a company might want to do that. Some bonds have an actual built-in provision that says if the company wants to buy back those bonds, they can buy them at a preset, predetermined price. You can see the term right here on the screen. Those are called callable bonds. Not all bonds are callable. If you were buying a bond, you would know at the time you bought it that it had that provision in there that gives the company the right to buy back those bonds at a preset price. So we need to talk about bond pricing just for a moment. That other page that I showed you in Brightspace is valuing bonds and finding bond prices. And so I want to talk about bond pricing for a moment, and this will take up the rest of our time. We're not really actually going to be able to do that next exercise until Thursday. So bond prices are stated as percents, but without the percent sign, and we call that an index. So a number that is really a percent, but we don't use the percent sign. The term for that is an index. So when we talk about bond prices, they're going to be around 100 or 100% of face value. So in the 3 exercises we've done so far, and again, I'm showing you that the information is here in Brightspace, but I'm going to talk you through it actually looking at the exercises we've already done. So the way we calculate a bond price is we take, and this is what it says in Brightspace, we take the selling price of those bonds. So in exercise 2, the bonds sold for $1.2 million, right? We take the selling price of the bonds. How much cash did we realize? And we divide it by, the face value of the bonds. So in exercise 2, the first one we did today, $1.2 million was how much we got for it. $1.2 million was also the face value. And so you would say that the price of those bonds is 100 or 100% of the face value. The price would be 100. Those bonds would be selling at par or at face value. Okay. We keep going though. So the price of a bond sold at par would be 100. Let's look at our next exercise. Sorry. Okay, so in our next exercise, in exercise 3, let's figure out what the price of those bonds would be. So how much cash did we realize from those? $14,376,255. And the face value of those bonds was $15 million. And so when I punch that into my calculator, move the decimal place 2 places to the right to make it into a percent, I get 95.8. I'm just going to put the percent sign in parentheses there. And so for this exercise, when the bonds sold at a discount, they sold for less than face value, the price would be lower than 100. These bonds sold at 95.8. The price would be quoted as 95.8. It doesn't mean $95.80. It means 95.8% of the face value. Okay. Let's go to our next exercise, the last one we completed, and find the price on those. Got my fingers on the wrong keys. That's not helpful. And so for those bonds in exercise 4, I found that they sold at 104.1% of face value. The price was 104.1. So if the bonds sell at a premium, the price is greater than 100. The more distance there is between the market rate of interest and the stated or coupon rate of interest, the bigger that premium or discount is going to be. And so a deep discounted bond is going to sell for, I don't know, 85%. So there's a big difference between the market rate of interest and the base rate. A big premium bond is going to have a price that's, 106, 108, 110, something like that. So in today's market, as I've already explained, as I mentioned earlier in class, interest rates are climbing pretty dramatically, pretty quickly. Interest rates are climbing. We know that that means bond prices we would expect bond prices to be falling, right? Because interest rates are climbing. So if bond prices are falling, interest rates are climbing, would bonds today that, a company started looking at last month or a couple months ago when interest rates were lower, and now they're selling them today, would you expect them to be selling at a discount? If you think that through, I think you'd see that the answer is yes, because they set the interest rate they were going to pay based on what they thought interest rates would be at the time they sold them. Turns out they undershot the mark because interest rates started climbing. So they're not going to be paying enough interest to be able to sell them at par or at a premium. They're going to have to discount them. That's why bond prices are falling as interest rates are rising. Okay, so that's where we're going to stop for today. We have a bunch of exercises left to complete on Thursday. I'm hopeful we'll still be able to get that done because we've got all the preliminary stuff out of the way, but please make sure you read Learning Objective 1 before Thursday, just to make sure you've got all that terminology down. See you then.